Hi everyone, we're going to give folks a few more minutes to log on and then we'll begin. Hello everyone, this is Candace Milner from the National Women's Law Center. I'd like to welcome all of you to our webinar, Making Care Less Taxing, State Child and Dependent Care Tax Provisions. This webinar is being recorded and will be sent out after the conclusion of the webinar. The cost of child and dependent care has been rising year after year, leaving families struggling to keep up. While direct child care assistance remains the most effective way to help families access child care, tax provisions for child and dependent care expenses can provide some help to families struggling to pay for the child care they need to support their children. The federal government and over half the states offer such tax provisions. NWLC has updated its comprehensive report on state child and dependent care tax provisions, making care less taxing. Today, we want to provide background on child and dependent care tax provisions and how they help families, share some models for tax provisions, including limitations and gold standards, and provide information about Colorado's experience with state child and dependent care tax credits. The presenters on today's webinar will be Amy Matsui, Director of Income Security at the National Women's Law Center, Sarah Hasmer, Income Security Fellow at the National Women's Law Center, and Bill Yeager, Vice President of Early Childhood and Policy Initiatives at the Colorado Children's Campaign. We hope that this information will be helpful to you. At the end of the presentation, we will have time for questions. We can't take questions by phone, but please send in your questions using the Q&A function, and we'll do our best to answer them at the end. After the webinar, we'll email you links to the PowerPoint, a recording of the webinar, and some additional resources, including the Making Care Less Taxing report. Thank you. We have a lot of ground to cover, so we'll get started.
Thank you, Candace. This is Amy Matsui, Director of Income Security at the National Women's Law Center. We really appreciate your joining us this afternoon for this webinar, and we hope, as Candace said, that we'll give you some information that's useful for you. Today, we are going to cover some general background about what are child independent care tax credits and how they can help families. We're going to talk through some specific models and policy aspects of tax provisions that help families with the cost of child care, including limitations and best practices. And then, as Candace mentioned, we're going to hear from Bill about Colorado's experience and perspective. Next slide, please. So I'm going to kick us off today by providing some general background information about state child independent care tax benefits. But I'm going to start by giving kind of a general overview of the kinds of different provisions that are available both in the federal and state tax code that are related to child independent care. So for families, first you'll notice that there is a federal child independent care tax credit, which is non-refundable, and we'll talk a little bit more about how that's structured. As Candace said, 27 states and the District of Columbia also offer their own child care tax provisions. 23 states in DC have credits, 12 of which are refundable, and 5 states have tax deductions. And we'll talk a little bit about what the difference between those is a little later in the presentation. I also wanted to highlight the federal dependent care assistance plans, and you may be more familiar with these as either cafeteria plans or flex spending plans, because these are benefits that are offered through an employer which allow people to set aside part of their salary to use tax-free to pay for child independent care expenses. And those have a limit of $5,000, but that is another benefit offered through the federal tax code. For employers, I also wanted to flag that there's a federal tax credit which is intended to help encourage employers to offer child care benefits to their employees. Employers can also use different deductions available through the tax code for business expenses. And a number of states also offer tax credits for businesses or employers that contribute either benefits in the form of child care or help in some other way support the child care system, including resource and referral agencies. And then finally, there are some tax provisions that help child care providers and teachers and staff because, as you may know, that's a sector, that's a portion of the child care system which is also dramatically underfunded and needs a lot of support to make child care more affordable and accessible for families. So that's kind of the general range of tax benefits that address child independent care, but today we're going to be focusing primarily on tax benefits that are available for families. Next slide, please. So states have a lot of options. They can make lots of decisions about what they choose to include in their tax codes, but we wanted to focus on the fact that child care, as you all know, is a significant burden for families, and the lower families' income is, the larger a portion of their budgets child care can consume. You've probably heard stories in the press about families who take second jobs or have to rearrange their schedules in order to accommodate the cost of the child care that they need to go to work and that their children need to thrive and succeed. One way to think about the tax benefits that are offered for child independent care is that workers with children incur costs just to go to work that workers without children don't. And so the tax code does offer some benefits for employment-related expenses, and for over almost 40 years, the federal tax code and tax codes of states does the same as well. So what we have seen is that even though direct assistance, as Candace mentioned, is the most effective way and can be a very significant way to help families with the high cost of child care, the federal Child Care and Development Block Grant isn't sufficiently funded or structured to help all families who struggle with the cost of child care. So what tax assistance can do is help reduce the amount of tax that families pay on their income, or in some cases provide tax refunds to give some more kind of disposable income to the family to help them with the cost of child and dependent care. Next slide, please. Thank you. So let's talk talk a little bit about what exactly is a child and dependent care tax provision. I'm going to give you some details about these provisions, which is general, and then we'll drill down when Sarah talks about some best policies and practices and some state examples. So in the most general sense, a child and dependent care tax provision is designed to help families who pay out-of-pocket, work-related expenses for child and dependent care. These provisions allow them to claim a portion of their child and dependent care expenses to receive a tax benefit when they file their federal and state tax returns. Next slide, please. Let's break this down. That was kind of a lot. So what do we mean when we're talking about out-of-pocket work-related care expenses? So the care that's provided and that's claimed under child and dependent care tax provisions has to allow the adults in the family to either work or in some cases to go to school full-time. You can't use it for volunteer work, so it has to be directly connected to employment for some of the reasons I discussed earlier. When we're talking about child care and dependent care, there are specific definitions for that under the federal tax code. Most of the states follow the federal definitions, but there are some variations depending on the state that you're in. But in the most general sense, child care refers to care for children under age 13. So there are a wide range of care arrangements that can be, whose expenses can be claimed under this credit. For example, care can be provided in the family's home or in a neighbor or relative's home. It can be provided in a child care center, a family child care home, preschool, before or after school care, and in some cases even day camps for summer or school vacations. When we're talking about dependent care, we mean care for a child over age 13 or a spouse or other family member who lives in the home with the family if that person is physically or mentally incapable of self-care. So one example of this is, someone comes by the house to care for the person or some other form of adult daycare provided in a center, but it specifically excludes residential living facilities or nursing homes. The person has to be in the family's home for at least 8 hours a day. And I should also mention that overnight camps for children can also not be claimed under these tax provisions, under these definitions. And then finally, when we talk about the care expenses having to be out of pocket, that means just that families have to pay for the expenses in order to claim them for tax benefits. This so for some families who do receive child care assistance, if the family is paying a copay or had to pay a deposit or in some way just pays something out of pocket, they can both receive assistance and claim the tax credit as long as the tax credit or provision is claimed for expenses that are paid out of pocket. This is also an area where there's a little bit of interaction with the flexible spending or cafeteria plans, because you basically can't double count expenses. If you claim it for the tax credit, you can't have reimbursed yourself through your dependent care assistance program. Next slide, please. So the next slide talks about exactly how the tax benefit is calculated. If you remember, we mentioned the fact that you have your child care expenses, a portion of them, kind of reimbursed through the tax code. So families generally can claim their eligible child or dependent care expenses up to a certain dollar amount. So usually under the federal tax code and most states, the expenses are limited. You can't claim all of your expenses. And this is a little bit of a problem because as many of you know, child care can range between $3,000 and $23,000 depending on average, depending on where the care is provided, the age of the child, and the kind of child care setting. So not all of the expenses that families pay can be claimed for child and dependent care tax provisions. In most states, the expense limits follow the federal, and that is $3,000 for one child or dependent, $6,000 for two or more. And then not only are the expenses capped, but when families claim the tax provision, they generally receive a portion of them. Often it's because a percentage based on income is applied to the amount of eligible expenses. So you have the percentage times the expenses, and that generally gives you the value of your tax provision. Next slide, please. And then before we kind of get to putting all of these pieces together, I did want to take a few minutes to talk through the different forms or structures that child and dependent care tax provisions can take. So this is a little bit of Tax 101, bear with me. So the most popular form of tax provisions, as you may remember from my initial summary slide, are tax credits, and this is the one that many of you may be most familiar with. So what a tax credit does is lower the amount of taxes that a family owes by a specific amount. So when families, fill out their tax returns, and there's a section that says, kind of calculates the tax, and then what the credit will do is wipe away a piece of that tax liability. And it can do that in one of two ways. If the tax credit is refundable, that means it will lower the amount of taxes a family owes, but if all of the tax liability is wiped out, Pac-Man style, and there's any of the credit left over, the family can receive that leftover credit in the form of a refund. So they will get money back in their pockets, possibly added to other tax credits that they may be able to claim if the tax credit is refundable. So that, unsurprisingly, is the most positive or most beneficial form of tax benefit for low-income families who may have very low tax liability. In contrast, if the tax credit is non-refundable, it can lower the family's tax liability, but it will not provide a refund. So the amount of the credit cannot exceed the family's tax liability. If you wipe out all of your tax liability, but you have some credit left over, if it's a non-refundable credit, you won't get anything back. And then finally, apart from the credit structure, some states will have structured their child and dependent care tax provisions as a tax deduction. And what a tax deduction does is not reduce the tax liability that's already been calculated, but kind of going back a step before that, it reduces the amount of income that is used to calculate the tax. So what it does is some kind of portion of the child and dependent care expenses are deducted from income before it's multiplied by the tax rate to get to your tax liability. I'm going to give you a moment to wake up, and then we're going to go to the next slide. Thank you. Okay, so just a refresher, just to review what we talked about in the last slide, tax credits are more valuable for lower income families if they're refundable. Generally what tax credits do is wipe away liability and may provide a refund afterwards if it's a refundable credit. A tax deduction is less valuable for lower income families, both because they have a lower tax rate than higher income families and because they may have limited tax liability. So let's put these pieces together and see how it might work in this sample family's example. So Christina and John live in Silver Spring, Maryland. They have 2 children and will have paid $6,000 in child care expenses this year. They earn $24,000. So theoretically, they can receive a federal child and dependent care tax credit, which is non-refundable, of $1,800. And then because Maryland also offers a non-refundable child care tax credit, which is based on the federal credit, they could theoretically receive a Maryland child care credit of $585. In actuality, if they claimed the standard deduction and also received the child tax credit on their federal return, they might not have any tax liability. And if that is the case, they wouldn't receive the federal credit, and because the Maryland state credit is based on the federal, they would also not be able to claim a Maryland credit. So that is not great news for Christina and John. Next slide, please. So the last thing that I want to quickly cover before turning the presentation over to Sarah is how tax provisions are claimed. So because tax credits and tax deductions are claimed in conjunction with filing either federal or state taxes, that means that it happens once a year. Families file their tax returns the following year in the spring or late winter for the previous year's expenses. So very concretely, they will claim their child and dependent care tax provisions in somewhere between January and April 2019 for the expenses that they paid in 2018. And just to flag also that families have to file, for the most part, a federal tax return, and they have to do that in order to claim these credits. And then they also separately are filing a state return. And if the state, I'm giving you a little preview here, bases their state credit on the federal credit, one return kind of assists in the calculation of the other. So that is basically kind of just to give you some background about child and dependent care tax credits more generally. And now I'm going to turn the presentation over to Sarah to talk about some of the specifics for state child and dependent care tax credits. Sarah, all yours.
Thanks, Amy. So states use different child and dependent care tax provision designs based on their state's needs, but there are some trends across states. Most states and the District of Columbia base their state tax provision on the non-refundable federal credit in some way. Some states base their credit or deduction on child or dependent care expenses up to a designated limit. About half of the states with credits have at least one refundable credit. Several states implement sliding scales based on income. So for example, a family with an income of $22,000 or less gets a state credit that's worth 100% of the federal credit. And then the percentage of the federal credit reduces with higher income levels. And then some states use income caps. And then a few states have quality credits, which are based on the rating of the child care facility the family used. These aren't for every state, but potentially worth exploring. Next slide, please. Some aspects of a tax provision's design present some limitations in the amount of assistance that can be provided to families. For example, advancing a tax strategy without advocating for direct child care assistance, non-refundable credits or deductions, low expense limits, calculating the state credit based on the federal credit received, and not indexing the credit amounts and parameters for inflation. Next slide, please. So that's a lot, so let's break down those limitations just a little bit. So timing matters. When setting an advocacy strategy, it's important to keep in mind that tax relief only comes once a year, but families incur child or dependent care expenses throughout the year. Direct child care assistance, such as through the Child Care and Development Block Grant, or CCDBG, is the most effective way to help families access child care because it provides financial assistance to families throughout the year as they incur their child care expenses. So families receiving direct child care assistance don't have to wait for the annual tax time to receive that financial assistance. Unfortunately, as Amy mentioned earlier, only a limited number of the families eligible to access direct child care assistance through CCDBG are able to do so due to insufficient funding. So given these factors, if you're trying to help more families afford child care, then tax credits should be paired with robust child care assistance. Next slide, please. As Amy highlighted earlier, non-refundable credits or deductions are less valuable for low-income families because they have little, if any, tax liability. And many low-income families do not have enough tax liability to claim a non-refundable credit or deduction at all. So let's consider just one example. This is some data from 2010 when California's credit was refundable versus 2011, the first year the credit was non-refundable. So in the graph, it shows that in 2010, more than 51,000 California families with an adjusted gross income between $1 to under $20,000 claimed the refundable credit. A year later, only 52 families in that income bracket claimed the non-refundable credit. So within the course of 1 year, it went from over 51,000 families to only 52. And the graph also shows that the next two income brackets also had significant reductions in the number of families claiming the non-refundable credit. So that distinction really makes a difference for families. Next slide, please. Okay, breaking down expense limits. So in 2017, average annual child care costs ranged from nearly $3,000 to over $23,000, as Amy mentioned, depending on the type of care of the arrangement, the age of the child, and location. In the same year, the median annual cost for full-day adult dependent care services was $18,720. Given these high expenses, designing a tax provision with low expense limits in turn limits the amount of tax assistance families can receive. Next slide, please. As mentioned earlier, most states base their tax provision on the non-refundable federal credit in some way. One way is calculating the state credit based on the federal credit received, which takes the family's federal tax liability into account. So this means that the state credit will be less valuable for low-income families. So remember Amy's illustration about Christina and John? They have an income of $24,000 and will pay $6,000 in child care expenses for their 2 kids. Their theoretical maximum non-refundable federal credit is $1,800, and the maximum Maryland non-refundable child care credit is $585, but in actuality, they may not have any federal tax liability, in which case they wouldn't receive either credit. Next slide, please. And then the last is failure to index. So child care expenses go up every year in the overwhelming majority of states. So not indexing the credit amounts and parameters, such as expense limits for inflation, makes the credit a little less valuable over time. Next slide, please. So let's change gears a bit and talk about what are some gold standards for tax provision designs. The tax provision, for one, is paired with robust direct child care assistance. It's a refundable credit with generous expense limits. That's more generous for lower income families. And if it's based on the federal credit, it provides some workaround for the federal credit's non-refundability. And then indexing for inflation. Let's see some examples of state credits that have implemented some of these gold standards. So first, Iowa has a refundable credit. It's more generous for lower income families because it uses a sliding scale. The maximum percentage on their sliding scale is 75% of the federal credit for families with an income of $10,000 or less. And while it's based on the federal credit, it has a workaround for the federal credit's non-refundability. So Iowa calculates the percentage of the federal credit before the federal credit is reduced by federal tax liability. And this is often done by taking, there are different lines on the federal form, and so there's one before the tax liability is applied, and so Iowa, for example, would take the amount of the federal credit before it's reduced by the federal tax liability. And then the maximum value of Iowa's credit is a little over $1,500 for 2 or more children or dependents, though the average credit is about $284. Next slide, please. Next, we have Oregon, which also has a refundable credit, but Oregon follows a different model than most states because it's based on expenses and not the federal credit. it has the most generous expense limits out of any state. $12,000 for one child or dependent, and $24,000 for 2 or more children or dependents. Generally speaking, it's more generous for lower income families. It uses a sliding scale based on income in addition to factors of household size and the age of the children. The maximum value of Oregon's credit is $18,000 for 2 or more children or dependents, but certain conditions have to be met in order to get that size of a credit. The average credit is a little over $1,000, much less than the maximum credit, but still a significant credit for families. Next slide, please. And then we have Colorado. And Colorado paired its tax work with direct child care assistance advocacy, which Bill Yeager will describe a little bit more later. And it has 2 refundable credits. Like many other states, it's more generous for lower income families by using a sliding scale for the tax credit that's based on the federal credit, and that's the child care expense tax credit. Families making $25,000 or less can claim 50% of the non-refundable federal credit they receive. And while that first credit is based on the federal credit received, Colorado created a second credit to provide a workaround for that non-refundability issue with the federal credit. They created a low-income child care expenses credit. So with this particular credit, families with incomes of $25,000 or less who do not have sufficient tax liability to claim the federal credit can claim this credit, which is worth 25% of their child care expenses, up to a certain maximum credit value. And these 2 credits have roughly the same maximum value and average credit. Roughly maximum value of $1,000 and roughly a little bit over $150 for the average credit. And now Bill Yeager from the Colorado Children's Campaign is going to share some of his work. Bill?
There. I think the unmute worked. Thanks so much for having us involved. I appreciate the chance to talk about Colorado's journey here around state tax credits and childcare more generally. I think that one of the things that emerged from the earlier discussion is the importance of having a sort of twofold strategy. That certainly a tax credit approach has been part of how we've tried to crack the nut around childcare access, affordability, supply, quality. But over the course of the last several years, that has been coupled with a commensurate focus on direct investment in childcare affordability. And I think that's just for us an important lesson to take away around what works for the system. And so as we look at lessons learned and kind of what we've worked on, that leads to sort of the first question area of focus. What problem are we trying to solve? And being really explicit about that. In Colorado, we have a series of tax credits, as you saw, low-income child care expenses tax credit that is designed specifically to respond to the lack of refundability issue around the federal credit and the low-income families' lack of a federal tax liability, which essentially has meant that there has been what we've sort of said is a glitch in our state tax credit, that you can't transfer your expenses from your federal tax form and claim a portion of them if you don't have that federal tax liability. And so legislators have understood the importance of the tax credit, the equity perspective, and the need for that one piece. So we were really explicit about what problem is that low-income one solving. The next area was sort of, we have a state-level child care expenses tax credit that is refundable. And that, I think many people understand the problem we're trying to solve there is to reach a little further into the low to moderate income bracket to offset with the state incentive a portion of families' expenses. And then we have a child care contribution tax credit that's designed to sort of come at the supply side of the availability of childcare. And so, not to go into the details there, but I think the lesson learned for us is those tax credits that we do have, we've tried to be really explicit about what problem are we trying to solve and making sure however we design the credit that it is targeted at that problem. In a related way, we've also been explicit that those tax credits aren't going to solve the larger issue of provider payment rates, quality improvement initiatives, families who, even if they are income eligible, aren't able to claim or don't utilize the tax code or face barriers to even filing taxes, and to understand that direct investment in our child care subsidy program is going to be a key piece of the puzzle for us. And so in that sense, we're trying to solve a different set of problems with the direct investment approach, related but slightly different. And so I think that's why, being explicit and clear with ourselves around the purpose of a tax credit or direct investment approach has been important. A second lesson learned has been really around the importance of refundability. I think that we have been fortunate to have partners throughout the early childhood space, including colleagues at an organization called the Colorado Center on Law and Policy and the Colorado Fiscal Institute, who are much smarter than us around issues of poverty and issues of the tax code. And so from a child's development perspective or a child care affordability perspective, we have value to offer, but they've also sort of been key partners in helping us structure our tax credits to be responsive to the particular needs that we have. And I think one of the areas that we've been really able to learn and think about these issues is around the importance of refundability. As we look at the upcoming session, we're talking about an early childhood educator tax credit. And in conversations with some legislators, refundability does come up. And there is a bit of a narrative that we have to counter around, is refundability a vehicle to have us writing checks out of the state treasury to people, versus is it a way that we make sure the tax code equitably applies, and that a tax credit in many ways is an incentive, and the incentive is not meaningful if it is not felt, and it is not felt if it's not refundable for a lot of the families we're talking about. So we've tried to develop improved ways to talk about refundability, to understand the politics of refundability, to understand the limits of the federal credit and the importance in Colorado of not just beefing up our existing state child care and dependent tax credits, but to create a standalone, related, but different section of statute that is specifically designed to address the lack of refundability and is targeted to families who don't have a federal tax liability. And then the final lesson I think we would offer is just the politics of tax credits. I think that they are tempting as vehicles because there's a perception that they come with lower administrative costs, that there's a perception that, we're not paying for programs, we're letting people keep money they've earned. And I think that that is can be used to our advantage to tell the story of the value of certain tax credits, but taken to an extreme undermines the importance of direct investment and telling the story about direct investment, coupled with a tax credit strategy to be able to tackle the many problems that we have. I think if you're not familiar, Colorado is a state with some unique constitutional provisions. We have a taxpayer bill of rights that caps the amount of revenue that the legislature can bring in. We have other challenges that we have to work through around mandated increase in funding, mandated for education, but mandated caps on revenue growth. And so tax credits become for some people, attractive as ways to, if we're over our revenue cap, directing funding in better ways. In other ways, they're hard because there's always a sense that we don't have enough revenue coming into the system to pay for all the things we need to do. And so let's close out tax credits to pay for K-12 education, to pay for transportation costs. And I think that being able to make sure we are at the table with a powerful voice around direct investment, and that tax credits serve a purpose, but not all tax credits are created equal, and that we need to make sure we're focused on the ones that are targeted families that we're working with, that we know need this targeted strategy. So I will stop there and see where we go next, but I'll be around for the question portion as well, if there are any additional lessons from Colorado that might be helpful.
Great. Thank you so much, Bill. That was really helpful. Next slide, please. So we have some resources for you. Get ready for our upcoming Making Care Less Taxing report. We've done a lot of work to revamp that from previous years to make it more user-friendly, and we will be sure to share it with you when it is published soon. Also, feel free to email us if you want any technical assistance creating or improving a child and dependent care tax provision, or if you would like some advocacy assistance like writing an op-ed or using social media graphics, which we will make available to you in the follow-up email to this webinar. You have a preview of some of those graphics on the screen with the Colorado credits. And now we do have some time for questions and answers. So the first question, let's see, maybe Amy. There's a question, so are both the non-refundable credits and deductions considered regressive?
Thanks, Sarah. So I think that we can safely say that deductions are kind of a regressive way to structure a tax benefit that's intended to help families, both because, as I mentioned, it's less valuable the lower your income is, rather than, as many of the credits are structured, being more valuable the way that the lower your income is. So the deduction is just not the most effective way to target low-income families, and in that sense, we definitely think it's a regressive benefit. And by the same token, because we know that the families at the lower end of the income scale, even if you've designed your credit to theoretically be more valuable if it's for lower income families, if the credit is not refundable, it really does limit the ability of those families to take advantage of the credit. And so I might not call it the non-refundable tax credits regressive so much as I might call them a missed opportunity and less effective than kind of the intent behind their design would mean.
Okay. Next question, did the tax law last year change the child and dependent care tax credit? And this is last December's federal tax change.
So this is Amy again. I will jump in and take a stab at this one as well. So the tax debates on the federal level last year, although there was a little bit of a setup which talked about child care expenses for families, Congress really missed an opportunity to improve the federal child and dependent care tax credit and help more working families. There were some changes in the federal tax law, including the increase in the size of the standard deduction, but also, as our colleagues at the Tax Policy Center have pointed out, an increase in the child tax credit. And the combined impact of both of those things is that families, and again, I'll refer you to some recent analysis by Elaine Mogg at the Tax Policy Center, result in families actually receiving less from the federal child and dependent care tax credit in 2018, now that the tax law is in effect, than previous years. And because, as we've talked a little bit about today, so many of the state credits are based on the federal credit, there's a trickle-down effect so that families are getting less also from their state credits because of the impact on the federal credit. So that's just something for families, for advocates and families to be aware of, that not only did the federal tax law that passed last December miss an opportunity to improve tax benefits for families with child care and dependent care expenses, but it actually puts them in a slightly worse position than they previously had been. So that is just something for you all to be aware of.
Okay, our next question is for Bill. Did you find any surprise partners or supporters in your advocacy work?
So I would say that the partners aren't necessarily surprising, but we have had really productive partnerships with the business community around tax credits themselves. Tax credits are something businesses are very successful at getting for themselves, that spend a lot of time understanding tax credits. So when we frame some of the childcare work in the lens of employee childcare affordability and a low administrative cost approach to helping address that issue, the business community has been supportive, including of the elements we've talked about, the low-income childcare tax credit and the childcare expenses tax credit. So that has not necessarily been surprising, but has been helpful, I would say.
Great, thanks so much for that, Bill. Okay, next question. What if families get childcare vouchers? Can they still claim the tax credit? Amy, do you want to take that one?
Sure. So yes, if families are paying any out-of-pocket expenses, so for example, if they have a copay, meaning that some child care providers can charge the difference between the amount they receive through direct child care assistance and kind of what their rate is. So for families who have to pay that difference or some kind of a copay and have expenses out of pocket, yes, they can claim those expenses for the child and dependent care tax credit. As many of you know, the income limits and as well as kind of the number of families who can receive direct assistance varies from state to state, but we know that only 1 in 6 children across the country receive assistance through the Child Care and Development Block Grant. So there may actually be quite a few families who are at least eligible to receive child care assistance but don't, who may be able to benefit from these credits as well.
Next question, and this might be for Amy as well. Can you explain a bit more about how quality credits work?
Sure. So there are a couple of states. Louisiana is one that's had a lot of attention paid to it lately. I'm going to focus on that. But also Maine, Vermont, and Arkansas have designed their tax credits to take quality into account in one way or another. Some of those states, that means that if quality child care center services are used, the tax credit is refundable. For others, it means that the amount of it increases. But the way that Louisiana has approached tax credits as a way to kind of bolster their child care quality rating and incentive system is to have kind of a palette of tax credits. So one credit is for families, and it's more valuable the higher rated care that they use. And then in Louisiana, their quality rating system only covers child care centers, so that limits the kind of care that families can use to claim this credit. In addition to a credit for families, there is a credit for child care providers. So providers who serve children receiving child care assistance who have a particular quality rating get an annual credit, which they can use to kind of sink back into infrastructure or providing materials, and that helps them kind of keep afloat and keep their quality ratings high. There's also a credit for teachers and staff who work in child care centers. who have received who have certain levels of experience, education, and training that is coordinated with a state agency that that monitors and kind of levels up professional credentials. And so if folks with a certain level of credential work in a quality rated center, they will receive an annual, as many years as they qualify, they can receive a tax credit that serves kind of as an income subsidy or like an EITC for childcare workers. And then finally, Louisiana has 2 credits which are kind of more focused on the business community, which, as Bill mentioned, are important stakeholders in the childcare system. And so for those businesses that make contributions either to childcare resource and referral agencies or who make donations or provide kind of slots or other childcare benefits for their employees, then they also are eligible to receive a refundable tax credit. So the way that Louisiana has designed their quality tax credits is to connect it to both the quality rating system, the credentialing system, and then thinking about all of the different stakeholders who can help support quality child care services in centers in Louisiana, and basically used the tax credits to kind of provide a little bit more resources to allow the quality of child care centers to be increased and maintained. So that is one approach. Nebraska has kind of taken an approach to helping both providers and child care teachers and staff, which is modeled on Louisiana. So we're kind of keeping an eye on that to see how that works in following years.
Great, thanks, Amy. We have one last question for Bill. You mentioned, and we mentioned earlier in our slides, about the need for dual strategies, direct investment plus tax credits. Can you talk a little bit more about how you balance the two from an advocacy perspective?
So I think it's hard, but I think that the hope is to tell a complete story about childcare and families' experiences in finding childcare, paying for childcare, understanding quality, that we have to tell the whole story. And I worry, quite honestly, that the narrative, and the only narrative that's out there sometimes, is about affordability. Certainly affordability of childcare needs to be part of the puzzle. But we do worry at times that the affordability narrative can dominate all the other pieces about, we're having a conversation about building a childcare system that works for families. That means we have to talk about availability, we have to talk about quality, and of course, affordability and what it means for families' budgets. And so it is tricky, but if we are doing the job of telling a complete story about what childcare looks like, you must conclude that childcare tax credits need to be part of the puzzle, and that they can be very helpful for different aspects of the affordability equation. But if we're telling that whole story, we're going to talk about the importance of direct investment, provider rates, building a system, understanding quality, ensuring that it's available in every community, contracting for slots, all of the other components of a childcare narrative. And so from an advocacy perspective, it can be easy to fall into just one of the frames. We're just talking about quality, we're just talking about availability, we're just talking about affordability, when you have a champion legislator who says, I'm going to fix the childcare affordability issue in our state. But I think that when we're doing our advocacy work best, we're telling the whole story.
Great, thanks, Bill. That was very helpful. Okay, so that concludes our questions and answers segment. I'm going to turn it back over to Candace.
Thank you all again for joining our webinar. After the webinar, sometime this week, we'll email you links to the PowerPoint, a recording of this webinar, and some additional resources, including the Making Care Less Taxing report. And that concludes today's webinar. Thank you.